After today's video, these results will become a familiar thing for you in a couple of weeks. The economics professor will tell you what really affects the stock market and teach you how to find the ideal entry points. But first, a little theory. Many people believe that the main task of the Fed is to adjust the rate to the level of inflation. It is believed that if inflation increases, then the rate should also increase. If inflation falls, then the rate should also fall. But in this case, this theory does not explain why in 2008, when inflation was at 5.5%, the Federal Reserve System moved to a decline a year before. Or in the period of 2016-2019, when inflation was at historical averages around 2.2%, the Fed for some reason began to raise the rate. Or the period of the 21st year. When inflation began to rise, the Fed suspiciously dragged on with an increase for a whole year. Do you really think that they sincerely believed that inflation was temporary and did not understand what consequences it could lead to? Strange, isn't it? Especially considering that every second blogger said that inflation would rise and that something should be done about it. Are bloggers as a single biomass smarter than the Fed analytical headquarters? Of course not. It turns out that the reason for what is happening with the rates lies not only in inflation. That's generally what is the central bank. The central bank is primarily an institution that controls the monetary base. And the monetary base consists of cash and bank reserves. With cash, everything is more or less clear, but what are reserves? Everything is very simple here. In addition to the central bank, there are many other commercial banks, for example JP Morgan, Citibank, and so on. And all these banks have correspondent accounts with the central bank. And there are funds in these accounts. They are needed so that banks can settle accounts with each other. And these funds are called reserves. That is, conditionally, the central bank acts as a link so that Bank A does not send a messenger on a horse with a bag of money to Bank B. These reserves are not taken into account when calculating the money supplied because they do not leave the limits of the banking system. Now remember this moment. An ordinary person or company cannot open an account with the central bank, but they can influence the monetary base. Because, for example, when you deposit money, you put it into an account with a commercial bank and it has an account with the central bank. So the main task of the central bank is targeting the key rate, that is, controlling the interbank rate, which is set on bank reserves. If, for example, the key rate is at 5%, this means that the central bank will pay 4% for the excess reserves that it has, and lend at 6%. When there are few reserves, the rate will rise. It's very simple. If there is a shortage for something, the price will rise. If there are a lot of reserves, the rate will fall. And now if we put bank reserves on the chart with the rate and inflation, then the picture will begin to clear up. Now it turns out that from 2016 to 19, the rate increased not because there were problems with inflation, but because bank reserves gradually decreased. That is, they became more expensive due to the deficit. And at the same time, if we look at 2021, the rate remained low in parallel with the growth of inflation because there were too many reserves. But the central bank will not give these reserves to anyone just like that. And if a private bank needs reserves or, in other words, money in debt, it can only get them secured by some assets that they eventually undertake to buy back. Most often these are bonds or mortgage-backed securities. If there is too much money in the system, the central bank withdraws it, for example, starting to sell bonds. I would like to emphasize once again that since this money does not leave the limits of the banking system, it does not have any effect on the money supply. Let's fix it a bit. If the bank gets too much money, then Fed comes up to him and says give me the money and hold the bonds in return. And if a bank needs money, it can get it secured by securities. And then suddenly QE appears. In the common people, this is printing money. In fact, it is buying up a large number of assets on the balance sheet of the central bank. Moreover, Fed can buy not only from commercial banks, but in general from everyone. If the purchase occurs at banks, the number of reserves increases, which means it puts downward pressure on the interest rate, but it does not affect the money supply in any way. But if Fed buys assets from the non-banking sector, then the money supply also increases. But in any case, no matter who the Fed buys from, bank reserves will increase. For example, If conditionally even you have a mortgage security and Fed will buy it back, and even if you don't put this money on deposit and go and buy a car with it, then someone else from whom you bought a car will put it in the bank, which means reserves will increase. And at the moment when the first QE appeared, and it appeared in 2008, it was a financial experiment. First of all, of course, QE was launched in order to save large corporations, banks, and private enterprises by repurchasing their depreciated debts. In the world of economics, this is called the creation of a zombie company. But in addition, it was assumed that an increase in bank reserves would encourage banks to issue more loans, which in theory should have stimulated the economy. But as it turned out later, the increase in reserves does not affect the volume of loans in any way. Because the only thing that reserves can affect is the key rate, and if there were not enough of them, the rate would grow, and it, in turn, should be controlled by the central bank through the provision of new reserves. And the central bank is not limited in the ability to create these reserves by printing money. In other words, money will be needed then they can be printed, and there was no point in doing it in advance. Therefore, the banks have gained practically nothing from this whole chic venture. And this is banal reflected even in quotes. Many key banks are still at levels below the mortgage crisis. But there was another ace up his sleeve. After all, the purchase was also in the non-banking sector. The idea was also noble. If you give them money, then they will let them into the real economy. They will start creating daring projects, they will start expanding, creating jobs, people will start living richer and GDP will eventually grow by probably 10% a year. But here too something went wrong somewhere. And there was no economic boom. And all because it came to the guys who were given free money very quickly. If they are given in unlimited quantities, if the rate is at zero, then why do anything at all? Why get involved in some business projects that may not work? Why create something and generally strain yourself? You can just invest in the market, wait for it to grow and make money on it. No, of course, some part of this money still gets into the real economy. It is not necessary to go from extreme to extreme that out of the trillions of printed dollars all will go to the stock market. But I think you understand the idea. In addition, as it turned out over time, not only did QE not restart the economy as we would like, it also created an additional problem in the form of an increase in the discrepancy between the incomes of the rich and poor segments of the population. That is, the rich became richer and the poor at best remained at their own. But even though the rich got richer and when they bought new yachts and Bentleys, they still did not do it in those quantities, and in general they were not the goods that could affect the restart of the economy. And here, with the arrival of COVID, another financial experiment was launched, namely the distribution of money to the population directly into their hands. This also became possible only thanks to the printing of money, that is, thanks to QE, and damn it, it gave its results. Indeed, the economy restarted. Therefore, it is quite possible that such a practice will be tried again. Only they will do it more covertly. For example, the stock market can become one of the bridges for transferring money directly into the hands of the population. It doesn't take much to drive a crowd there. And if people start investing in a market that will always grow, it will solve a lot of problems at once. Firstly, people will get richer, which means they will spend more. But at the same time, unlike 2020, they will get richer gradually, which means that the risks of provoking hyperinflation are reduced. Also, if people start investing in a market that is always growing, this may encourage them to take out more loans against the future growth of assets. And most likely it will be, so the option is quite viable. But with a caveat, this particular point of my monologue is a theory, because there will be a parallel with helicopter money, and it's still about the inflationary environment, and we don't know yet whether the Federal Reserve System will go for it. I mean, there will be debt repurchase, that is, QE in any case. The question is open in terms of whether such a scenario will be included in it. But anyway, as we found out today, the more they are going to print, the lower the key rate should be. And it is impossible to drop it now for a conditional 3 months to 0%. Because despite the slowdown in the economy, there is still no obvious recession, which means that with a sharp reversal, inflation will start to accelerate again and all the work of the last couple of years will go down the drain. So if we plan to launch the printing press, then not earlier than next autumn. But the most important thing is that before starting to implement this project, the Federal Reserve System wants to reduce the volume of bank reserves to the nominal range. That is, the QT program, according to various analytical publications, will continue for at least another 6 months. In the meantime, bank reserves will be reduced. The rate will automatically be at a high level, which will put additional pressure on the economy. So think about how justified the hopes for an early reversal of the Fed are now. But as I said above, the rate primarily affects the real economy. For the market, it is not the rate that is much more important but liquidity. And in order to understand how it is calculated, now you need to remember what an overnight repo is. Let's speak in very simple words, so that everyone can understand it if possible. In general, this is such a thing that the Fed came up with in order to reduce excess reserves. That is, financial institutions transfer their money to the Federal Reserve System and in return receive a short-term security for 1 day. And for the fact that financial institutions park their money in the Federal Reserve System, they receive a percentage that will be in the area of the key rate. Now this value is 5.3%. This amount naturally goes in annual terms, that is, financial institutions do not receive such frenzied interest overnight. But why did the Federal Reserve decide to open this attraction of insane generosity at all? Part of the idea is that when reserves are withdrawn, it means that they will become more expensive, which means that banks will lend less, which in modern realities should provoke a slowdown in inflation. That is, on this chart you just see that the yellow line is bank reserves. As we found out, when the QE program is underway, bank reserves are growing. The green line is the balance sheet of the Federal Reserve System, and it is clearly visible that in the period from the 19th year to the end of the 21st, both the balance sheet and bank reserves grew. The volume of overnight repos has been actively growing since March 21st. At first, its growth went in parallel with QE, so bank reserves still increased. But then it can be seen that when QE ended and QT subsequently began, bank reserves fell down even more because at the time of the end of QE, the overnight volume continued to grow. From the outside, it may seem that reverse repo is a real godsend for banks. You were once given a lot of money, but now you can do nothing at all and get 5.3% a year. On the one hand, it seems like yes, it smacks of parasitism. But on the other hand, you need to remember that this yield is unstable, and it changes depending on the change in the key rate. That is, if the rate starts to fall, then the yield will fall. And secondly, this money goes overnight out of desperation. This money, as it seems to many, cannot be invested in the stock market, except for short-term periods. They also cannot invest in some dubious business projects. They are, so to speak, practically locked in this system without walls and a lock. This money only does what it lies and waits for the moment when bonds appear on the market. Because buying them means buying a collateral asset that can later be borrowed, remortgaged, and then remortgaged again. But when we talk about market liquidity, there is another component that excites the minds of investors, namely the Department of the Treasury. He has funds in his accounts that are periodically spent, which manifests itself in the form of a drop in this schedule and are periodically replenished either through tax revenues or through the placement of bonds, in other words through their sale. It is generally believed that when the funds of the Department of the Treasury are reduced, this means that money is coming into the system, which means it will support the markets. When the Department of the Treasury goes to borrowing, this means that money is being pumped out, which means it will be negative for the market. Well, there is a third option when the funds of the Department of the Treasury grow due to tax revenues. It is believed that this is also generally positive for the market because the money will eventually be spent. But here we need to make a very important reservation. When such a correlation is carried out, it does not mean that funds from the Department of the Treasury accounts are directly transferred to the stock market. Firstly, the main task of the Department of the Treasury is to distribute funds across the social environment. That is, it is the salary of teachers, maintenance of schools, army parks, and everything like that. And secondly, when the Department of the Treasury moves to borrowing by placing bonds, then the very word bonds suggests that we are talking about the debt market and not the stock market. Therefore, it seems that the influence of Department of the Treasury funds on the stock market really looks like a theory that is far-fetched. And if we take the period of the 20th year, the question may arise as to why, when the Department of the Treasury borrowed so much, the market grew at the same time. But when the Department of the Treasury spent funds from 21 to 22, the market grew even stronger. But from the end of the spring of 22 years until June of this year, funds were spent, but the market did not go to update the highs. And it really is. When we separately consider the balance of the Federal Reserve System, bank reserves, overnight volume, or funds of the Department of the Treasury, then some nonsense constantly arises. For example, now the balance of the Federal Reserve System is shrinking, but the market continues to grow, although logically it should have fallen a long time ago. After all, otherwise you can ask the question why then so much money was printed that created all this inflation, and at the same time it eventually turned out that the market can grow without a printing press and the economy has somehow not collapsed yet. Therefore, when we talk about liquidity that will directly affect the stock market, all these factors need to be taken into account at the same time. In a minute I will explain everything in detail and clearly. But if we are talking about the Department of the Treasury, then in very simple words, so that it is clear to everyone, you can imagine the following situation. When the Department of the Treasury moves to borrowing, it generally does not affect the amount of money, it affects their movement. That is, there was money on bank reserves or overnight repo, and then they went into bonds that the Ministry of Finance placed. This money from bank reserves or overnight, as I said above, would never have entered the stock market in full, but they thus went to the Department of the Treasury. The Department of the Treasury won't let them into the stock market either, but it will let them into the real economy. As such a stupid example, he allocates $100 billion for the purchase of sweets as part of a social project for the hungry. The seller of these candies has already purchased them on credit or in installments from the manufacturer in advance. And having received this money, accordingly, with some profit, part of it can go to pay for the loan, part for the purchase of new goods, and the rest of the money can be partially invested, for example, in the market. I note once again, this is just an example for the sake of an example so that it is more or less clear how it all works. Well, now let's finally fix everything. I'll show you how to calculate liquidity, how it affects the market, and how to understand its further movement. In general, the balance sheet of the Federal Reserve System certainly plays a dominant role. When it grows, it means money is printed, that is, the QE program is running. When it falls, it means money is being pumped out of the system, that is, the QT program is running. Well, as we know, when money is being printed, it is very positive for the market. In addition to the balance sheet of the Federal Reserve System, there is the Department of the Treasury. And within the framework of the example above, it is considered that when funds are spent it is a positive for the market. When funds are replenished it is a negative. Until the summer of this year, the balance of the Federal Reserve System was shrinking, which in fact was a negative for the market. It was supported by the fact that the Department of the Treasury was spending its funds. And here is the first life hack for you: how to globally understand what will have a movement on the markets. When the balance sheet of the Federal Reserve System grows at the same time and the Department of the Treasury borrows money, this is generally positive for the market because there will still be more money printed and entering the market. When the balance grows and the funds of the Department of the Treasury are reduced, this is generally a mega positive for the market. When the balance stops growing or even starts to shrink, and at the same time the Department of the Treasury borrows, this is a real negative. When the balance is reduced, but at the same time the Department of the Treasury spends funds, this is generally a neutral situation, but with a bias rather towards the negative. And at the moment, the situation will be determined by what is more. If the Department of the Treasury gives more than the Fed withdraws, then in general it will be a positive signal. But when we talk about liquidity, which has an impact on the markets, we do not forget to take into account the volume of overnight repos. This money can support the market at the moment, but it is a short-term action, and it usually does not last longer than a few days. That is, for example, we see that when the Department of the Treasury does not give money and at the same time liquidity does not come from overnight, that is, the blue graph grows at this moment, the index is actively falling. And vice versa, when the blue and red charts fall, this is a positive for the market. Well, there is a third option. When one grows and the other falls, at the moment the situation on the market will be determined by what happens in the end. If more money is received than has been removed, the market will support it, and accordingly vice versa. Starting from the summer of this year and up to November, money from overnight flowed into the Department of the Treasury, so they did not have a positive effect on the market. Summer growth was associated with euphoria around AI, and by the beginning of November, the market returned to previous levels. But once again, the money from overnight can only provide short-term support. However, it is such a component as overnight that gives us a clear idea of what is happening with liquidity at a particular time. And the available liquidity can be calculated very simply. This is the balance of the Federal Reserve System minus the funds in the Department of the Treasury accounts minus the overnight repo volume. If this chart is growing, it means that liquidity is coming in. If the chart is falling, it means that liquidity is being withdrawn. And since you and I know that the market goes for liquidity and not vice versa, if we put an index on this chart, then almost 100% correlation is visible here. If global liquidity falls, the market will also fall. If global liquidity grows, the market will also grow. But there is one interesting nuance that allows you to earn. Firstly, there is a small time lag here, which allows you to predict the future movement of the market, depending on what is happening with liquidity now. And secondly, since there are still a huge number of participants trading in the market, it is sometimes subject to euphoria, panic. There are some reactions to the news that get rid of liquidity. But since, as I have already said, it is the market that eventually goes for liquidity and not vice versa, our task is just to look for these imperfections. For example, when we want to take a long position, we need to find a moment when the market will already receive liquidity while the market will be at the bottom. That is, it means that there is money, but the market is afraid of something. When we are looking for short entry points, we should look for those moments when the market will be at some highs that will not be backed by liquidity. This means that there is too much unreasonable optimism in the market, unreasonable euphoria that will eventually be blown away. So, understanding the essence of this process, in order not to look for discrepancies on these charts, we can divide the index into liquidity, and we will have an indicator with improvised support and resistance levels that will show us how much the index is overvalued or undervalued relative to liquidity. Well, it is logical that entry points to short are sought from the resistance level and from the support level to long. And if you look closely, you will see that this indicator has always reached resistance or support zones a few days earlier than the index did. That is, you have time in reserve to make a decision. The most important thing is that this indicator is leading and not lagging. And now, when this indicator continues to be at such high values, it may seem that this correlation no longer works. But this is not the case. Take a look at this diagram. Here, the red candlestick chart is the S&P index, and the red line from below is the S&P divided by liquidity. The green candlestick chart is the Russell 2000, and the green line is the Russell divided by liquidity. Please note that somewhere before spring, the correlation of both of these graphs was almost 95%. But it is starting in the spring and then in the summer that we see that the S&P has started to overtake Russell. Moreover, in July, when the S&P reached the extreme overbought, Russell grew only to the overvalued zone. There is such an entertaining picture on the web right now, where you can see that the entire growth of the market continues solely due to a very narrow range of technology stocks. And pay attention to the fact that when the divergence began in the spring, it was then, judging by this schedule, that everyone began to invest in tech. That is, the gap here is now on the face. Well, as of today, you can see for yourself at what levels these charts are. Russell now has the potential for growth, but since the divergence between these two indices is too large, in the coming days we will see how the S&P will begin to adjust. The nearest target is where the index will be 4,350 points. Good luck and see you again.